Today, I have a guest that have done a deep research into financial crisis and private debt. Welcome, Richard Weig.
Thank you for having me. It's a privilege to be here.
It's our pleasure, and thank you for taking time to share your findings with us. Many times when we speak about financial crisis, debt and money, I get the impression that we don't highlight enough that it's actually mainly about our lives and what kind of society we create. And I know that you have spoken to many families hit by financial crisis. So before we get into your research, can you tell us what the consequences have been for these families and the economy at large?
Well, you're exactly right. It's not worth spending the time on economics unless we are ultimately thinking about the well-being of people. And the great financial crisis is a great example. Millions of people in the United States lost their homes. Even many of those that didn't lose their homes found themselves in a financial straitjacket. I gave a speech somewhere talking about folks that had mortgages that were underwater. They had once upon a time, because of the boom, made more money. Now they were making less. Their house was worth less, yet their mortgage was still very high. And as a consequence, they had not for years been able to take vacations, buy a new car, make an addition to their home, any of the things you would associate with economic growth. And as I concluded, a whole bunch of folks came up to me and said, that's exactly my life. We aren't able to send our kid to school. We haven't bought a car in 10 years. We haven't taken a vacation in 10 years. It's real lives of real people.
Wow, we cannot have it that way. And I think it's very good that you've done your research in that case, because it shows what the causes for these financial crises are. And if we know them, we should be able to do something so we avoid them too. So, but what is your background in banking?
Well, I started off in banking way back when I was actually trying to work my way through college. I got a job in a bank, and it just all flowed from there. And I was in the banking industry for perhaps 35 years. And I was fortunate enough to become CEO of a bank. So I was in it a long time.
Okay, quite extensive inside knowledge.
I have the scars to show for it.
Okay. So why did you do this research on private debt then?
We, as a practical matter in our bank in the 2000s, prepared a monthly report showing growth in household credit cards, which is most of what we did, home mortgages, which we didn't do, but impacted our business, auto loans and so forth. And we noticed probably about 2004 or 5 that there was this unprecedented, extraordinary growth in home mortgages. We began to be worried. We began to talk to economists, other folks in our institution, and we're told again and again not to worry about it, because even though debt was growing, home values were growing even faster. And so, the trade-off was a positive for consumers. Well, we didn't know a lot about economics, but we knew a lot about paying your loan. And we knew that, even if values went up, if you didn't have the cash to pay your loan, it was going to end up bad. And we thought, since most of what we were doing was unsecured credit, we thought that trouble in the mortgage business was going to impact us. And sure enough, it did. And from that, massive dislocation in the global economy, we began to wonder, I began specifically to wonder, was this just something that had happened with the Great Recession? Or was this something that had happened in other points in history? And so it took me a year or two, but I finally got around to studying the Great Depression, Japan's great crisis in the 90s, and really ultimately dozens of other financial crises, and found that it was a common theme, much to my surprise, that it was always runaway lending. It was always, quasi-irrational lending and excessive growth in loans that was the precursor and, in fact, the cause of financial crises.
So it was too high private debt that was the causes of financial crisis. Okay, and did you only research in Japan, on US, or what countries were involved in this research that you did?
Well, we ultimately, we kept having conversations with folks where we were trying to point this out. And the fundamental thesis, by the way, really is about overcapacity as much as it is about debt. Because what happens is lenders get enthusiastic, make way too many loans for commercial buildings or homes, and ultimately build way more, and I don't mean just a little, millions more homes, thousands more office buildings than are needed. And kind of a great correction occurs. The institutions that made the loans on the buildings or homes fail or come near failure. The construction industry has to lay off, millions of workers. So there's this cascading effect that we call the crisis. But it's really about the creation of overcapacity in a very compressed time frame. And so we kept making that statement, and we kept having conventional economists push back on that. So we kind of thought, damn it, pardon my language, we're going to check this out. And we took it upon ourselves to look at the 6 largest economies in the world over a 200-year span and identify all the major crises. And there's a consensus of about 43 crises, financial crises, that occurred in those 6 countries over 200 years. And we did research on all of them. And it took us a while, but we did something almost nobody does. Most people look at the point of crisis and the aftermath. And we said, we need to look at the 5 years prior to the crises and see what was happening. And sure enough, whether it was, the 1980s and 90s in Japan, or 1873 in the US and in Germany and Austria, it was massive lending in advance. In the case of Japan, it was office buildings, not just in Japan, but in California and Hawaii and a lot of other places. In the 1870s, it was railroads, which really are a kind of specialized kind of real estate loan. Far too many railroads were built for the passenger demand that actually existed. And so we didn't find a single example in those 43 crises where it was anything other than over-enthusiastic runaway lending that led to the overcapacity that led to the crisis.
Wow. I think that says quite a lot. So could you see any indexes or something like how much does the private debt has to grow before you're in the red or something? Did you find any numbers like that?
We came up with a rough rule of thumb. As you have said yourself and others have said, economics is not physics. So it's not like, at this temperature, water boils kind of a thing. But it's about human behavior. So there's great variability depending on circumstances. But what we said was that it was roughly true that if there was growth in private debt to GDP, and GDP is a proxy for income. So if you say debt to GDP, what you're really saying is the same thing as your loan officer says when he says debt to income. So if a country's aggregate private debt to its income grows more than, let's say, 20% adjusted for GDP over a 5-year period, there's probably an 80 or 90% chance that you're going to have a calamity of some sort, whether it's an outright crisis or a near crisis, might vary. And we've since done a lot of work around that and come up with other metrics, but it's kind of a rule of thumb. I would also mention to you that there's great variability on the outcome depending on how much help the government provides at the point of crisis. So you have a period like 1930 where the government basically throws up its hands and says you're on your own, and you end up with a decade-long depression. And there's other times, like our more recent crises, where the government intervenes with trillions of dollars, and it's still tough, but it's not nearly as tough. So if you take 08 versus 1929, the collapse in GDP in the 30s was almost 50%, as you know, which is unimaginable today. The collapse in GDP in 08 and 09 was 2 or 3%. So you can see how big of a difference government intervention makes.
Okay, thank you very much for that. So what do you think we should learn from this research that you have done?
Well, I think what we should learn is that laissez-faire, unfettered markets often lead to problems. And you could go so far in the case of banks that to say, because in the United States, there were banking crises in 1797, 1819, 1837, 1857, 1873, 1884, 1893, 1907, 1914, 1921, 1929, and then more recently, the crisis, mild crisis in the 70s and the big crisis in 87 and 08. So you can say, you can easily conclude that about every generation, folks have forgotten the lessons of the prior crises, have regained their enthusiasm, and are at risk of overlending. And there's really a role for regulators to take that as a sign of, to scrutinize banking and lending practices. Because the other thing I would tell you, and this is interesting, me as a career lender, loans never grow that rapidly unless lending criteria is relaxed. So you can't have the same, if your criteria on a mortgage loan, for example, is a 20% down payment and a 30% debt to income ratio, and you keep that intact, it's largely going to be impossible to ever overlend. It's only when you come in and say, no down payment, we're not going to check income. In some cases, folks were lending more than 100% value of the home. So there's a fundamental change in credit criteria that allows for the rapid increase. Same thing on office buildings, same thing on private equity deals. You'll see lenders do what's called covenant light, or relaxing or eliminating certain types of covenants. So, if I would think as a regulator, if loans begin to grow at a very rapid pace, which we can roughly define, maybe like 4% to GDP per annum, that it's time for us to go in and investigate lending practices. And you might say, this gets back to your first point, you might say, that's the bank's problem if they change their credit criteria. But if they misbehave, they'll fail and they'll suffer the consequences. But we've seen that's not the case. We've seen what happens is millions of folks that had nothing to do with it suffer. And so, I think it's appropriate within a society, not to be heavy-handed, but to be alert for signs of excess. And in that case, I think you end up with a healthier economy.
I think that was excellent last word on this topic, Richard. Thank you very, very much for those and taking your time to share your knowledge from practicing banking for 35 years and the research that you did in all those 49 financial crises that you found. Thank you very much.
It's a privilege.